Good morning, everyone. And to those that are in other parts of the world, good evening, I should say. Thank you, Bill. Thank you, Nalinia. Um, as Bill had mentioned earlier, we're living in very interesting times, as George Friedman said, the calm before the storm, and as hedge fund manager Ray Dalio has alluded to, perhaps a new changing world order. So in my report, we cover a little bit about what is happening and where we might be going in the future, how that relates to the markets, as well as the economics, and what that really translates to you in terms of your jobs, your lifestyle, and the future of the economy going forward. So just I thought this slide would give a good picture of kind of what is happening and where we might be going. And this would be a nice little way to describe to you in a layman's way about what you're going to be facing here for the next 12 months, and then what's going to happen potentially going forward into 2023. Just a little historical perspective. The first part of the slide talks about the inflation ramp. And what you should know about that is that, you know, since we went off the gold standards back in the 1970s, we've had what we call the great financialization. 23 trillion in central bank assets that have been put on the books of central banks, 18 trillion in negative yielding debt, 30 trillion in public debt. And then in the most recent past 2 years during the COVID pandemic, we printed about 30 to 40% of the previous money supply in just 2 years. What that has really culminated in is an everything bubble that is now, in the past 12 months, has transitioned to monetizing those underlying financial claims to real world assets like oil, natural resources, materials, real estate, food, and the production like farmland. With obviously too much money chasing too few real world assets and the claims on them, and a supply chain crunch on real production, the only possible outcome that we could see possibly from that would be rampant inflation, which is what we're experiencing now. So the good news is that we might have hit peak inflation, and I'll show you a little bit about why. But what's going to be going from here? Where are we going forward? And what is that going to look like in the next 12 months? What that's starting to look like now is we're moving into the stagflation phase. That is essentially a period of time where we're going to see slower growth, potentially recession. And what that's caused from is that we're seeing lower real wages and less disposable income because of inflation. And obviously now we're witnessing the declining wealth effect of those that have financial assets in the markets and in bonds and other related assets as well. Potentially going forward, that might even include housing, possibly later this year or next year. But with fewer assets to monetize and less income, that's going to lead to a period where we're going to have slower growth, but we're still going to have inflation. And we're going to see less of it, hopefully. We're starting to see some peaking in the oil patch, as well as in some other key materials. But the embedded ones are particularly in food and those things that are going to take a while because they're somewhat supply chain related. And it's not going to be something that is going to go away in the next couple of months. It's going to probably take a few quarters, maybe even more, maybe the next 12 months. So this is particularly a treacherous period here. What happens is, if you probably have been paying attention to the news last week, Target and Walmart reported their earnings, and they both had very interesting insights about what they're seeing, since they, you know, combined probably represent somewhere about $800 billion of sales. They were saying they were noticing that there was a shift in consumer demand and consumption of durable goods, which that makes sense when you think about it, that a lot of us may have beautified our home, done things that we invested in our local, things that we like to do in our home and other things like that, appliances, furniture, all those kind of things. They were seeing less demand for that. Yet the things that they were selling a lot of, which is obviously food, was still very costly to them in terms of the input cost due to inflation. And so obviously they had a crunch of lower demand in some of the high priced items and the very high margin items, like durable goods. And in the more mainstream items like food and such, they don't make a lot of money there. It's very difficult. The margins are very low in the first place. So that's telling about what they're going to be looking at going in for the rest of 2022. That means potentially, even though they may have good revenues because the consumer is still spending, the profit margins are going to decline or contracting. For those that are working or have real jobs in those kind of capacities, manufacturing and any kind of retail, watch out. This is going to be a period of time where companies are going to need to figure out how they're going to rein in their costs and what they're going to do about that. And so that's going to entail a lot of things and potentially might even entail a few layoffs. I know we saw Amazon made some changes in some of the facilities that they were considering to use for expansion. That's just an early warning indicator. So for the next 12 months, slower growth is looking like what we're going to be looking at. We're seeing it in the financial markets already in terms of some of the high duration asset classes like technology that have future earnings out in the future. It's really shifting right now to the only areas in the market that are actually performing are energy and utilities. Everything else is seeing some form of contraction. Not necessarily that they're going out of business, but the valuations that they're paying for those assets are coming down. So after that, which is the next 12 months into 2023, we're going to be then looking at the next phase, which is obviously a very treacherous period, which is the deflation phase. In this phase, we may have gone into a slowdown or at least a mini recession. And now the housing prices and those things that are longer term assets, because of the fact that the economy is not producing as much, we might see a contraction in the housing market as well in 2023. This is a period of time that is very difficult for many people, and you should prepare yourself. Make sure your finances are in order. Make sure your businesses are in order. Cut costs, do whatever you can just to make sure that you have enough assets on the sideline to be able to weather the next couple of years. The good news here is that the seeds of the next boom are in the deflationary phase. That is usually when companies invest, particularly back into technology and those productive asset classes, the next generation investments, which are going to be Internet of Things, 5G, the cloud, et cetera, all those things that reduce costs and increase efficiency. So that's just the backdrop of where we're going. A few slides for you to kind of consider. What we've been looking at, obviously, is the high inflation situation, particularly in food and energy. And those are the ones we're concerned about that will not dissipate very quickly in the short term. We see used car sales, obviously, they're still inflated, but they've come down noticeably. And because we're seeing some changes in the supply chain already, which is giving us some indication that we might have hit peak inflation. As I mentioned, what happens in this phase is that we're going to be looking at potentially a slowdown later this year. And historically, when we have inflation periods that are more than one standard deviation, which is in this case today, we usually have a mini recession or a slowdown. So this is what this is giving you a quick overview about. What is the Fed doing? Well, the Fed doesn't control supply. The Fed only controls demand. And the historical perspective on what the Fed has done is not particularly great in terms of being able to do what we call a soft landing. I haven't seen one, maybe you have, but I think they're very rare indeed. Maybe we could look back to 1994, where we had a little bit of a period where Greenspan thought we had a rational exuberance and he raised rates really quickly, but then he came back down. The Fed is going to try to raise rates and basically do what we call demand destruction by raising the borrowing costs and contracting the amount of credit. Credit is usually the key problem for the markets. It's not necessarily some of the other things of employment related. It's the access to credit that contracts the underlying amount of money that can be invested in the markets. And so we're going to be looking at some more rate hikes. And what the Fed is going to try to do over the next couple of months is raise rates very quickly here to crush whatever is out there in terms of inflation. So that is the good news, because that will hopefully end this period of time where people are really getting hit on the real wages. And that is a problem for the more mainstream people on fixed income. As I mentioned, we're starting to see some changes in the supply chain, which is leading to this problem of potentially might be already past the peak inflation. One measure of that is the inventory to sales ratio. And this was revealed by some of the largest companies like Walmart and Target, that they had a lot of supply in the things that people wanted to buy, but people weren't buying them. And what they're going to probably have to do is they're going to probably have to liquidate those appliances and those other kind of durable goods to basically sell them off. So that is already a sign that we may have seen the period of the supply chain problem already dissipate. As you can see here, the LA and Long Beach ships at anchor has come back to pre-pandemic levels. So anyway, the good news is that we'll be looking at hopefully lower inflation. Consumer sentiment is really starting to be getting very discouraged, particularly because of inflation, which is not a good sign for spending, which is why we're talking about slower growth potentially this year. Hopefully that'll pick up. And part of the reason why is real average weekly earnings are lower, even though people are making more money. So while they got more stimulus and maybe are making more money on the nominal side, their real income is dropping. And corporate profit margins are contracting, which is also one of the things that corporations were going to look at in terms of what are they going to do about controlling costs. And that is particularly a problem for people that are working. They may actually have to do some layoffs if things slow down too much. As I mentioned, I'll just leave you with a little bit on the markets, and then I'll turn it back to Bill. The NASDAQ is now in a bear market, which is not surprising. We've probably witnessed a large decrease in the technology areas and companies. The S&P 500 briefly touched the bear market minus 20%, but has dropped back below that. But the financial markets are going to be in a lot of duress for the next 6 to 12 months, particularly because of what the Fed is trying to do with interest rates. So brace yourself and hopefully have a plan. The good news, and I'll leave you with this, is that the forward projected price earnings ratio, which is a measure of valuation, is now getting back close to historical norms. So if you have enough bandwidth and you're looking at the long term, you might start looking at how can you participate sometime this year and definitely into 2023. It's most likely that we may see a lower market before this is all over, because we're getting into that liquidation capitulation phase. But this is also an opportunity to start building a list for opportunities in the new next generation investments, which are also down 50 to 70%, many of them, but also the good quality names that we all know about, that we all like, that we all think are the future as well, in the cloud, in 5G, and in some of those key areas of technology that are going to drive the next boom after we get through this challenging period. So that's my presentation for today. Thank you very much, and I'll turn it back to you, Bill.